Hi, welcome back everyone to day 79 of our live challenge. Today we are venturing into the exciting world of global investing. But with so many options, where do you start? Let's explore the two main categories, developed markets versus emerging markets. Have you ever considered investing outside of India? Okay. So imagine your investment portfolio as a well balanced meal. Developed markets are like reliable staples, think rice or dal, providing stability and consistent returns. Emerging markets, on the other hand, are like exotic spices. They offer the potential for high growth, but can be a bit unpredictable. Developed markets represent economies of countries that have a long history of economic and industrial growth. These countries typically have one, strong institution, well established legal and regulatory frameworks that protect investors and business. Second feature is advanced infrastructure, reliable transportation network, communication system, and financial market. Third is diversified economies, not reliant on a single industry or a sector. This helps to mitigate risk. So, the advantages of investing in developed countries are, you can take it first one as a stability. Developed countries offer greater political and economic stability as compared to emerging markets. This translates to less risk of sudden disruptions or policy changes that could impact your investments. Second advantage could be reliable companies. You are likely investing in the household names like blue chip companies with a long history of profitability and dividend payouts. These companies tend to be less volatile and provide a more predictable stream of income for your portfolio. Third benefit can be lower volatility. Developed markets generally experience less dramatic swings in stock prices. This can be a major advantage for risk averse investors who prefer a smoother investment journey. So, fourth benefit can be established stock exchanges. Developed markets have well regulated and transparent stock exchanges, making it easier to buy and sell investments. Fifth benefit can be deeper liquidity. A higher volume of trading activity, making it easier to enter and exit investments without significantly affecting the price. But there are a few drawbacks also, like slower growth. Developed economies tend to grow at a slower pace compared to emerging markets. This can mean potentially low returns on your investments. They have mature industries. So these markets may not offer the same level of innovations and high growth potential as emerging markets. Also, there is a valuation concern. Stock prices in developed market can sometimes be higher due to their established status. So potentially it limits the future upside. Now let's look at the emerging market. What are emerging markets? Emerging markets are basically developing economies with the potential to become the economic powerhouse of tomorrow. So think of countries like China, Brazil, or India itself. These economies are experiencing rapid growth. They are driven by factors like young and growing population. So, emerging markets boast a larger younger population as compared to developed markets. This translates to a larger workforce and a growing middle class, which fuels consumption, spending, and economic activity. The second feature of this economy is rapid urbanization. People are moving from rural areas to cities, creating new opportunities for businesses and infrastructure development. Third feature you can look at emerging markets is that there are emerging industries. These markets are often at the forefront of new industries like technology, renewable energy, and healthcare. This presents exciting investment opportunities in sectors that are still in their early stages of growth. So there are many advantages of investing into emerging markets. Like first one can be faster economic growth. Emerging economies are are growing at a much faster pace than developed economies. This translates to potentially higher returns on your investment, especially over the long term. Second advantage can be untapped potential. Emerging markets offer a chance to invest in companies at the ground floor before they become the household names. This can lead to significant gains if you choose the right companies. Third advantage can be diversification benefit. Adding emerging market to your portfolio can help you diversify your holdings and reduce your overall risk. This is because emerging markets tend to have a low correlation with developed markets, meaning they don't always move in the same direction. Emerging markets offer exciting investment opportunities, but also come with some significant drawbacks to consider, like political instability. Emerging economies can be more susceptible to political unrest, corruption, and policy changes. This can create uncertainty and disrupt business activity, impacting your investments. The second drawback can be currency volatility. The currencies of emerging markets can be much more volatile than those of developed markets. This can lead to significant swings in the value of your investment, even if even if the underlying companies are performing well. The third drawback can be limited liquidity. Compared to developed markets, emerging markets often have low trading volume. This can make it more difficult to buy and sell investments quickly, especially when markets are volatile. Fourth drawback can be less transparent regulations. Emerging markets may have less stringent financial regulations and corporate governance standard as compared to developed market. This can increase the risk of fraud or mismanagement by companies. There can be also infrastructure challenge in these countries. Emerging economies often face limitation in infrastructures such as transportation, communication, and power. So this can hinder business growth and economic development. So which one is right for you? The answer, like most thing in life, it depends. So consider your risk tolerance, investment goals, and time horizon. So for risk averse investors, developed markets might be a safer bet with their stability and low volatility. And for long term investors, emerging markets with their high growth potential can be attractive for long term wealth creation. Investors who are seeking diversification, they can consider a mix of both. This helps to spread your risk and capitalize on opportunities over the group. And for investors who are seeking diversification, you can consider a mix of both. This helps you to spread your risk and capitalize on opportunities across the group. So here are some additional things to keep in mind for Indian investors. So first one, invest in what you understand. Research companies and market before putting your hard-earned money into it. Second, beware of currency fluctuations. Emerging market currencies can be volatile, impacting your returns. So start small and gradually increase your exposure. Third, don't jump in head first. Diversify within each category. Remember, there is no one size fits all answer. The key is to understand the risk and rewards of each market and choose an investment strategy aligned with your financial goals and risk tolerance. Happy investing! And if you have liked this video, don't forget to forward it to your friends and family. The link for the upcoming webinar is given in the comment box. Please go and register for it. Bye. See you.